I'm going to allow each of the panelists to introduce themselves very briefly before we ask the first question. So if we start down at the far end with you, Blake, please.
Blake Olafson, I'm based in Singapore. We're focused on investing in the natural resource space. We represent some high net worth family office capital, and we generally invest in Asian companies backed by Asian capital.
Eric Sprott, Sprott Inc., big investors in precious metals, including trusts listed on Toronto and New York, both for silver, gold, platinum, palladium, and a specialty in resources.
I'm Mickey Fulp. I'm AKA the Mercenary Geologist. I write a newsletter, analyst in the junior resource sector, focused in North America, live in Albuquerque, New Mexico.
My name is Jörg Kiener, Swiss Asia Capital in Singapore. We're running funds mainly resource-oriented with a large exposure to the precious metal sector, focus Asia Pacific for about half the assets. Revenue flow from investors' point of view is about half Asia and half Europe.
Great, thank you. So we are here to discuss in broad terms asset allocations, options and strategies in today's mining market, as potentially we look at recovery and growth, which I think is quite optimistic, and potentially what appetite investors have for mining companies in 2013. So if I may, again, starting with you, Blake, at the far end, can we just have an idea of what sort of commodities, regions that you're considering? What are you looking at, and what do you think will be attractive to investors this year? And actually, let's not confine it to this year. Let's give you a little bit of leeway and give it the next 5 years.
Next few years. We're focused primarily on two areas. One really is the growth area of a lot of these emerging markets, in particular in the copper space, where we still feel very strong in the fundamentals around copper. As a lot of you know, I used to work for Ivanhoe, so we've been kind of inundated with the whole concept of copper is the only thing that everybody needs. We also look at the building material space quite a bit in terms of the limestone and cement production. We feel that in the real emerging markets, when you look at brand new kind of, let's call them super frontier markets, like even Myanmar and things like that, where you have some of the lowest consumption of cement in the world, these countries are really building a lot of new infrastructure, and they really don't have any. They have the physical geology there, but they don't have any of the operations and technical expertise. So we see a great opportunity in those areas, and I think that really doesn't matter in what happens to the global market, because these economies will be able to be domestically driven. And if there is a global meltdown, they're still going to build roads and bridges. So we're kind of focused on things that can be used domestically and aren't as impacted by the global markets. And I think that goes through for several years.
Well, I specifically focus in on precious metals, and I focus in on those because I have a deep, deep concern about the financial system, the over-leverage of the financial system. For those of you who were at the presentation this morning, I explained the leverage, and I worry that this financial crisis is far from over, and I'm into the precious metals as an alternative to all other paper assets. And in terms of the stocks, they've been badly beaten up here as they were in 08, 09. I remind people that at the end of the bottom in 09, they went up by something like 200% in 9 months, and I fully expect that type of recovery here if we see a move in gold, which I think there's great reasons to see a move in gold and silver here over the very near term.
Eric, can we just have a quick thought on you regarding what we've seen going on in the Mediterranean in terms of what it potentially might mean that the banks have lost the trust of depositors?
Sure. Well, it's interesting. All problems these days are bank problems. The problems in Cyprus is a bank problem. That the problems of the banks are bigger than the country, and they can't solve them. And we wouldn't have problems in Spain and Portugal and Italy if there weren't for bank problems. Because, you know, Spain tried to bail out Bankia, and of course they lost 19 billion last year. And of course the sovereigns have been caused to step in there, because if you don't save the banks, as you know, everything ends. That's the theory. And so it's really a bank issue. I don't know what the resolution of that will be. My guess is that Germany is tired of bailing out countries. Spain, Portugal, Italy, as I mentioned, Greece, Cyprus. And if Germany sticks to their guns, I would suspect that maybe this weekend we'll see the other powers get involved, because we're not talking a lot of money here. I mean, the U.S. prints that in a week, so it's not that big a deal. But I would think that if the Germans will probably stay resolute, and maybe others will come in and help solve the problem.
Thank you.
I'm focused on copper, because 25% of the world's people, 1.75 billion people, can't turn on a light switch. They live in the dark. That's going to change, and it's especially going to change in Eastern Asia. I'm also focused as a contrarian on the supply-demand fundamentals of uranium. Look very compelling to me. So I'm always looking for good uranium companies, and my niche really is explorers and developers, not miners, because at least in the Toronto market, I think that's where money is made, with the advanced explorers. That's your best upside. And we run a model in the newsletter which demands a double of share price in 12 months or less. You sell half your stock, take all your money off the table, and then go find another one. You still have half your position. So copper, uranium. With regard to precious metals, I'm very interested in platinum and palladium right now. I think once again, the supply-demand fundamentals are compelling. The average cost of platinum production worldwide is $1,600 an ounce. That cannot continue with 60% of the world's platinum companies breaking even. I wish I could find a good platinum palladium company. At this point, I am unwilling to accept the geopolitical risk of South Africa.
Mickey, can I just come back to you on uranium? Obviously, post the horror that we saw in Japan 2 years ago, I was, and still am, bullish uranium. I set the world's first uranium fund up. We were the biggest shareholders in Extract, so we've put our money where our mouth is. Do you not think that it's going to take 10 years for the uranium market to return?
Well, I actually think it's much shorter than that, and I can't tell you when the spot price is going to recover. It's still about $42 a pound. The long-term contract price is probably $60 now, but most uranium mines, new uranium mines that come on stream, are going to need 80-pound uranium. We have 66 nuclear reactors currently being built. And where's the uranium going to come from? This year we have 24 million pounds of uranium coming off the market with the end of the Russian HEU to LEU, megatons, megawatts if you will. That's coming off. And we're running a supply deficit. Even in 2011, with 48 of 50 Japanese reactors offline, we still ran a 13% deficit in the uranium market, was what was used with what was mined.
Thank you.
From Swiss Asia point of view, we are focusing basically the precious metal universe. The main question we have is wealth preservation, so not necessarily making money, but not losing money, particularly from a purchasing power point of view. So we have a huge exposure on the physical side, particularly silver, where we see the leverage on the derivative exchange going ballistic. We are focusing on the corporate side, the equity side, on development and de-risking stories, so people who are fully funded are able to accelerate growth and being able to return money to their shareholders on the end. I think if you look at the universe today, it's appalling to see really large companies which after 10 years of bull market have only margins of 10%. I mean, if I'm a sausage maker and I could sell my sausages at 8 times the price, I would expect a decent margins on profitably for my shareholders. So looking at really margins and sustainability of a business, I think, are key. And so bottom-up work, stock selection is key in this market to really return money to your shareholders.
So in effect, what you're really saying is you've got to make the right decisions about the management teams, because unless the management team delivers, which most tend not to, we were talking about this earlier on, when have you ever read a feasibility study and the mine, when it starts operating with those numbers? I don't believe it's ever happened, has it?
Look, I think we like companies where management has skin in the game, where they own somewhere between 5 and 20%, and they're getting remunerated not by options, but basically by a dividend flow. And so once you start seeing that, you actually see that the shareholder structures are quite tight, and the interests are realigned, and I think with that you're able to unlock value.
And in your quest for picking the right stock, Blake and I were just talking a little bit about Mongolia. I mean, are you prepared to go up the risk curve in terms of jurisdictions where you might look for those assets?
Look, I think jurisdictions are becoming riskier globally. I think people who believe there's a no-risk area to invest in, I think they are wrongly guided. I remind people that in Canada we imposed basically backwards taxation on energy trusts at one stage. I think in Australia we had the windfall tax on coal. So the risk-free countries do not really exist anymore. They are just basically different cycles of where the risk lie. And there are some countries we will not invest in because we think we're going to be diluted and have no rights of imposing our rights. But I think people should be much more open to risk. For us, one of the countries which is the highest risk is the United States. A lot of people will look really strangely at that, but if you have a country which is bankrupt, the risk that I'm getting taxed away on my benefits is relatively high. And the price of that is now in today's world a perfect price where none of that risk is assessed. So maybe taking different risks in other countries might pay on the end on the return side as well.
Thank you. We will move on to the second point to ponder, which I guess is probably quite topical for the gentleman sitting up here, which is really resource funds and ETFs versus individual mining stocks. Where do you feel the capital's being allocated? I've sat on panels before where I've basically been the only person who's actually been an advocate of owning individual names and all the associated risks that come from that. And these guys have bought physical commodities and ETFs. Mickey, can we start with you, please? Well,
where is capital being allocated? There's not much capital being allocated right now, and I think that's really a big part of the problem with the mining business. We have gone from traditional ways of funding mining development, which have been essentially equity, bank debt, and government subsidies, and we are now moving into non-traditional ways, which would include sovereign funds, hedge funds, private equity funds, royalty streams, and metal offtake agreements. And I expect those non-traditional ways of raising capital to take a bigger part of the financings in the mining industry going forward.
Eric, could you just, because I know you've been involved with some of the silver streamers in the world.
Sure. Well, obviously I've been a huge believer in investing in equities, and I'm a huge believer in your individual efforts being paid off by seeking out an opportunity that's way superior to the average. And even if I went back and looked at our, for example, gold involvement with gold back starting in 2000, I absolutely refused to buy the big cap companies and instead chose smaller companies. They outperformed the big companies by so much, it was unbelievable. So I'm a huge believer in staying in equities. I have no problems with owning physical gold and silver or funds where you can get the physical gold and silver, but I really think there's a huge opportunity for those who want to do their homework to invest in equities.
And given where valuations are today, would you be sort of at the bottom end of the spectrum rather than worrying about the big boys?
Well, I think so. For example, in my own view today, I think I'd be a seller of metals to own the mining shares here. They've gone down so much vis-a-vis the price, and I think the risk reward is really flipped over now.
And given what we've said about management teams and the sort of habitual disappointment that they potentially cause, I mean, you're obviously better at reading human beings than potentially I am. What do you say to people there who just basically will say, well, the ETF, it just mitigates risks. I don't have to back a management team. I'm not taking geological risk. How do you solve that one?
Well, I think that you have to assess every situation independently, and if you can see something that has a very substantive reward that the market's not paying for, you have to trust in your own ability to analyze these things. And yes, the average guy might want to buy an ETF, but I can tell you that a real true investor will want to buy something that has the most return for the least amount of risk, and I certainly always believe those opportunities are out there.
Blake?
I mean, I would agree with certainly what Eric's saying. We always look for the unique opportunity, and if we're not outperforming the average, which really just the ETF signifies as the average, we're not really doing our job in terms of finding the right team. So it really comes down to like backing the 4 or 5 senior management guys that we're willing to put capital behind, and believing in those in the management team. I think the shift in terms of some of the way that we look at the investments, I think some of the structures have changed, where we're seeing more convertible bond issuance that might be tied to performance. We just did one recently that if management didn't perform, there was a very big interest rate stick that kind of gave them a whack. To keep everybody in line and keep things on track in terms of achieving the goals. So we're always looking for management teams that have been there, they've done it before, and it's not just kind of buying into a dream. It's more experience. So for the guys who are fresh on the street trying to do it for the first time, I think it's certainly going to be substantially more difficult to raise capital.
But I would hazard a guess that the our sector as a whole, has suffered because the leaders of the pack, the Rios, the BHPs, the Anglos, the Goldcorps, the Newmonts, the Newcrests, they have all serially underperformed. They haven't given investors the return that really they should have done. So how do we go about assessing that sort of? And these are meant to be getting it right. You can forgive a gold explorer for not drilling.
Yeah, but I mean, we always think that some of the you have 70,000 people in Rio Tinto, right? Nobody really owns it at the end of the day. So if you've got the 4 or 5 guys who have substantial ownership and skin in the game themselves in terms of the success of the project, then we would much rather find those guys out, and we think that they will significantly outperform, I think as Eric mentioned earlier, significantly outperform the big mining companies. So we would never just kind of be lazy and buy Rio Tinto, to be honest. Sorry.
No, and I'm with you.
I think if you look at asset allocators nowadays, then you see that the total investments in the resources space is actually halved over the last 2 years. It's actually amazing. It's below the 2001 level. So investors have actually quit in panic ways, and we've seen redemptions, stocks which are really cash flowing at one stage. We see companies which are trading at 1.5 years free cash flow, and that compares with an index return on the S&P, which is doing that actually from a risk point of view just on the opposite side. So what we are looking at is to come back in that sector in order to pick up this cash flow, and the issue is, how do we do that? I think investors are getting tired to live on promises, and the only way we can do that is capital discipline and return of shareholder value to the shareholders. So you need dividend yield, and that's actually a very interesting tool as well, because if you have no dividend yield and no yield, it becomes very easy for the general market to short your stock and go along something which has a yield, and you leverage it up, and all of a sudden you have 20%. So I think where the mining industry will have to find this ability is to create sufficient margin to reward the shareholder, its growth, and its sustainability. And unfortunately, among the largest mines, we've seen a lot of lip service. I haven't seen really proper agendas on how to cut cost and being able to deliver that. Whilst for a lot of tightly held companies, I see that. I'm very happy to sit there and wait for the trust to restore and see money coming back in and reprice that stuff to levels which is actually quite decent. So your return risk mechanism right now, that universe is actually quite fantastic.
And you mentioned redemptions. I'm not sure what size the ETFs. I'm not sure if we've seen inflows or outflows. Maybe Eric could answer that. But in terms of where we are in the redemption cycle, without maybe speaking about your own firms, can I have everybody's view on that? Because I think the redemptions becomes a self-fulfilling prophecy. The retail investor starts taking his money out of the sector. The fund manager is compelled to sell at whatever price it is, and unfortunately it invariably drives prices and valuations into the ground. I was speaking with Eric on the way in here, and a very dear friend of mine in London said he saw his biggest redemption year to date, or since this recent downturn. He's a clever old goat, and he would suggest that that potentially marks a bottom, but I'm not sure if we've got further to go.
Well, there's a theory in our business that funds follow performance, and it goes both ways. When you don't perform, the funds leave, and when you do perform, the funds come in. And I'm always reminded that there was a study done of mutual funds that in whatever time period it was, probably in the 80s and 90s, it said the average mutual fund went up 8% a year, and the average fund holder made nothing because they always follow the flow. When the fund's weak, they sell it. If a fund's strong, somebody recommends that you buy it. So yes, there have been, everyone in our business has experienced redemptions. These things follow a cycle. If the gold price wants to move up here, the stocks, of course, will provide excess leverage, and people will come back into the fold again. And there's nothing we as fund managers can do about it other than to try to preach basically what Jörg was saying, is have the companies focus more on returning capital to shareholders. And that's something when we talk to the issuers that we have investments in, we're pointing out to them in a zero interest rate world, a dividend is a very valuable thing. So please think about it a little more than you might have otherwise before.
Mickey, have you got something to add to that?
Well, yeah, I do. It seems to me that it's becoming increasingly obvious to me, I should probably say, that the mining industry is not a growth industry. It does not follow the typical New York Stock Exchange model of growth for growth's sake. The mining industry is a value industry, and too many major mining companies have treated it, especially the gold companies, over the last, say, 10 years since this gold boom started, as a growth industry. So they must return capital to their investors. They must have significant dividend yields. We're starting to see that a bit. And we've seen, let's just take all the gold companies, major gold companies, we've seen CEOs' heads chopped one after another over the last year, let's say, or certainly the last 6 months. But I don't know any gold companies or any mining companies or any major companies in the world that where the CEO is a dictator and he's the guy that makes the decision. The decisions are made by the board of directors, and I think the board of directors should go on a bunch of these underperforming major to mid-tier gold companies.
Blake, in terms of getting the money back into our space, getting the money out of the mining companies, what do we have to do? What do we have to see? Mickey mentioned the platinum group metals, all-time lows. None of these mines are making money, yet investors want to return, costs going through the roof. Do we have to see massive price escalation in these metals, or how do we cut costs? What do you think is an answer?
Yeah, I mean, I think the only thing really within the control of a lot of the companies really is their own cost structure. And you can't really control where the price of gold is going. We would all like to, but nobody really can. But what we can do is control a lot of the costs that exist within the organization itself. The days of, a bunch of guys flying in and flying out who all live in Vancouver for lifestyle reasons and they're running, a mine in Mozambique doesn't really work anymore. I mean, you need guys in country on the ground.
And they earn 200 grand a year.
200. The secretary makes 200 in a lot of these companies.
So
how do you, a lot more than 200.
How do you go back and say, right, chaps, your salaries are
Well,
high?
yeah, I mean, one of the hardest questions we always ask people is, your hardest decision is going to be when you have to fire yourself to some of these guys who are running these companies. I think capital will flow to those companies which have a much better cost structure, and I think we're seeing that. We're also, and people recognize that they're not going to have these huge expat layers of management over top of each other over a local operation. So I think localization will occur, and I think capital will reward those companies appropriately and flow to those companies.
Eric, anything to add on that?
Well, not really. I mean, I can see a paradigm changing here, that when you're in a zero interest rate world, which none of us would have imagined would be in this world, that dividend becomes important. I know that we're actively involved these days in suggesting to companies that they got to pay out a return here, and don't commit to the next mine that takes another 3 or 4 years, because I don't think the market has any patience to look 3 and 4 years down the line. That's the issue, that it's been so bad.
Did we bring this upon ourselves by funding, because we've all written checks on this desk, funding too many mediocre assets, which have now sort of bitten us in the arse?
Perhaps. And I can tell you that now when I have a management come in to see me and they're doing very well, and the guy says, and I want to talk about, developing this new project, I just groan. Please don't start a new project. I'd much rather take the money right now, thank you very much, and get your market cap up before you commit to something that uses all your excess cash flow for the next 3 years. So hopefully that process slows down. We're seeing it amongst the majors, right, where the majors are now cutting back and curtailing their capital expenditures. And I think you'll also see it forced by fund managers like ourselves who say to the companies, don't spend the money, give it back to us.
So do you think we could basically be going into a new era where mining companies are going to have their project, which will produce X, and they're going to say, right, 50% of that goes back to shareholders, and we'll retain the 50%, and if we can go on to live on that 50% and develop our new product? I mean, are we getting into that sort of...
Well, I also make the argument that if you pay the dividend, you'll get a better market capitalization. Yep. And by getting a better market capitalization, you can use the market to fund your capex. As you know, most mining companies can't borrow money, because it's just not something that banks like to lend against. But I think if you paid the dividend, it was a sufficient enough return, your market cap would go up, and because you have the coupon on your stock, you can way more readily attract funds in the capital markets to provide for your future expansion.
Yeah.
I think I agree fully with all what's been said, but I think people are incredibly pessimistic, and everybody asks, where's the demand coming from and how do we get the price up? And in every demand-supply equation, we should actually look at the other side of the coin too, and one of the coins here is going to be supply. As we have right now, basically a large reduction on capital expenditures, our future production is actually going to start falling quite significantly in a lot of these little areas by 2015, 16, 17. That's not that far away, that's just around the corner. These 3 capex reductions which are coming right now are going to filter through the bottom line to the shareholders. So we're going to see over the next 12 months decent returns coming back to shareholders. That's going to have 2 implications: a demand-supply imbalance, which is going to start moving prices up and start moving basically share valuations back up again. At least it's a 2-year window which we're going to have. The new management which have been appointed onto many of these companies, that's their job. That's what they've been asked to do. If they don't perform within the next 2 years, their head's going to roll again. So we're going to see all the efforts basically to create shareholder value, which might, in 2 years' time, put pressure on sustainability of business. So don't be surprised if you see miners high grading in order to get the return, but in the short term, certainly shareholders will see lifts and benefits out of these very aggressive changes which are occurring right now in the industry.
So that potentially then means slightly further down the road, the pendulum swings back and we go through this whole excitement again of high metal prices because we don't have enough to...
Basically, you already see that happening. I think if you look at Glencore, they're all over the place trying to get copper concentrate because they've got a huge derivative book, they've got commitments to deliver, and there's just no decent copper concentrate coming out. So we're already there, and now you start adding capital reductions, you start actually seeing that people are paying quite decent prices. There was a deal done last week where Glencore offered $160 million on a gold copper concentrate, no whistles attached, no hedging, no nothing. That shows you actually that the market to get good delivery on a real asset and output has actually already shifted.
And it was a bit like Silver Company paid, I think, quite a handsome price for a silver stream in Canada a couple of weeks ago as well, which Eric would know about. Okay, well listen, I think we've probably missed a window, luckily for you, to answer or ask any questions. Is there anything else anybody on the panel would like to say or got to say?
I would like to touch on the idea of projects and the idea that during 2009, 2010, past global economic crisis, especially in the North American markets, we had too many juniors with bad projects. I'm a field geologist by training. There are just not that many good projects in the world. So we have too many juniors with too little capital. I think what we're going to have here is a washout. I don't know how long it's going to last. It certainly looks to me that at least 1 to 2 years before the North American junior resource sector will have a significant recovery. But I am a field geologist, and because of that, I tend to be an eternal optimist. And I think what we're going to come out of this with is a leaner, meaner, cleaner junior resource sector, and there are going to be more good projects and less bad projects funded.
And having just returned from PDAC in Toronto, I would agree with you. Gentlemen, thank you very much indeed.
Thank you to our panelists, to Andrew, Jürgen, Mickey, Eric and Blake. Thank you very much. Great panel.